What's up everyone, it's Karthik with MoneyVest. Welcome on board for our Powell live stream. So Jerome Powell is going to be talking in about 40 minutes or so. And I'm also going to be going over the statement, which is going to be coming out in about 8 minutes. So we got lots to discuss. Just give me one quick minute while I get things ready. And we should be all set and ready to go here. And hope you all are doing great. I've mustered the courage to go live. Last few days, of course, have been pretty exhausting, and I've definitely taken on more than I can handle. So yeah, but we'll get through this. I'll only be live for about an hour. If the audio and the video is good, just give me a thumbs up, and we should be good to go. I literally had to ask permission from a few of our members just so I could go live, because a lot of people wanted me to just take a break and not go live, but I can't do that to you guys. I can't. I've gotta come live. So okay, so markets are indeed open. We've got the FOMC statement coming out in about 7 minutes. So 7 minutes is when the statement is gonna come out. And again, if you guys can see me and hear me, just give me a thumbs up. I just want to make sure the audio and the video is working well. Are you guys ready for the old man typical speech, is what Kaz says. Yeah, it's hopefully it's not the same old speech that we're used to hearing. Hopefully it's going to be maybe something new, some more additions, but right now, of course, the market is very much pricing in for a rate pause. So if you come over to the Fed Watch tool, again, we're going to get the statement in about less than 6 minutes here. The market's pricing in for a rate pause, about a 97% probability that we're going to see a rate pause between 4.25% and 4.5%. And we're going to get that right over here. So I'm going to reload this as soon as 2 p.m. hits. As soon as we get that report in about 5 minutes, I'll reload this and we'll take a look at that statement together. In the meantime, do me a favor, just share this live stream with as many people as you can. Just, on WhatsApp, Telegram, Discord, wherever you want, with your friends, family, other traders and investors, so we can take a look at this together to what Jay Powell has to say in about 35 minutes. And of course, what the statement is going to look like for the FOMC. So the first things first, as soon as 2 p.m., I'm going to reload this page. And we're going to look at this paragraph right here where they're talking about the interest rates. And if it stays at 4.25% and 4.5%, then we'll know that is a rate pause from the Federal Reserve standpoint. And then the speech will begin in about 35 minutes. So hope you all are ready. NVIDIA is sitting at a new all-time high, getting up to 179.40. The market cap is now sitting well over 4.3, almost 4.4 trillion dollars. And then we've got SoFi bouncing back higher a little bit, from the after hours and the pre-market sell-off of $20, $21. We're back under 22, but still out down on the day. And of course, Tesla is down almost 1%. We got Palantir up over 1.3. I'm going to switch this up to S&P 500. As well as the NASDAQ, because that's what we're going to be focusing on right when the statement comes out. So let's just do a quick poll on our stream and see what everyone has to say. Markets after Powell speech: rally or take a dump? So let's just do this poll here. We'll see how many votes we get until the Powell speech in about 30 minutes or so. But the most important, of course, is going to be the statement right now, and then we'll look into how the markets react in about 4 minutes here. So 4 minutes to go. And I also want to go over my portfolio, which is right about here. Open P&L now sitting just over $86,000. Hopefully in the next couple months, I'll be able to get this up to 100 grand in open P&L. If August and September is not brutal, if August and September holds up really well, then we could be on a very nice trajectory higher, and the overall trend has been very strong for the market, for a lot of portfolios, for everybody, right? So the markets have been performing really well. So Nvidia, I'm really considering rolling out a couple of my options. So you can see that I've got the 170 calls expiring on August 2nd, and the other one's August 30th. So this one's going to be this Friday, which I am considering rolling out a little bit because I am down, and I don't know if I'm comfortable selling at 170 now that I know that Nvidia is getting up to 180. I can maybe push it up to 175. So those are decisions that I've still got to make later this week. So I'll definitely do that. Zero Loof, thank you so much. I really appreciate that. It was actually very nice talking to you today. And thanks for the donation, man. I really appreciate that. You don't have to do that, but thank you. I appreciate that a lot. So make sure that you participate in the poll. We've got the report coming out in 2 minutes. So 2 minutes we'll get the FOMC statement. And then, of course, the Powell speech is going to be at 2:30 p.m. Eastern. So in about 32 minutes, we'll take a look at the market's reaction. We'll do a little bit of a discussion among ourselves. I know, Trump's been pushing the Federal Reserve and Jay Powell to actually cut rates. But I doubt that he's going to do that, especially when you consider the inflation numbers as well, right? So if you come over to BLS.gov, if you come over to Consumer Price Index, and take a look at the overall chart and how it's been performing, it has been elevated, right? It's been somewhat elevated. It's staying above that 2.3, 2.4. Now, this last month was a big uptick, from 2.4 to 2.7%. That is substantial, right? On a year-over-year basis, it's a 30 basis point increase. And, we've seen a 40 basis point increase from April. So that is concerning. It's moving back higher. It's now closer to 3% as it is closer to 2%. If you take a look at core CPI, that's also been stabilizing a little bit at 2.8 and recently ticking up to 2.9. So headline 2.7, core sitting at 2.9. So both of them are very high in terms of where the Federal Reserve wants it to be. So we'll see if Jerome Powell gives us any insights into rate cuts later this year, or if it's going to be an entire year without rate cuts. So about 15 more seconds left. Make sure that you participate on the poll. Make sure that you share this live stream. And we are ready to go in about 5 seconds here to reload the page, look at the market's reaction. We've got the S&P, the NASDAQ, and it's 2 p.m. Eastern in New York. I'm going to reload this page as soon as that report comes out. There we go. There's the PDF. And the rates are steady. No rate cuts as expected. In support of these goals, the committee decided to maintain the target range for the federal funds rate, 4.25% and 4.5%. That's exactly where rates are. The markets are non-reactionary for the right reasons, because it was going to be a bit of a nothing burger anyway, because it was a 97% probability that the rates were going to be paused, meaning steady. We are moving up a little bit. The NASDAQ is moving up. You can see the S&P moving up just slightly, up over 29-30 basis points. And the NASDAQ is also up over 0.5%. Right now, we're seeing a bit of an uptick in stocks as well. Nvidia just shy of 180 right now. Tesla just shy of 319. But we are seeing both the S&P and the NASDAQ seeing a little bit of a push higher. The real question, of course, is going to be what Jerome Powell says. So this was just released less than a minute ago, July 30th, 2025. This is the latest statement from the FOMC. Although swings in net exports continue to affect the data, recent indicators suggest that growth of economic activity moderated in the first half of this year, and the unemployment rate remains low. The labor market continues with conditions that remain solid. Inflation remains somewhat elevated. That's what I was going over earlier. Inflation is elevated at 2.9% core, and then all items is sitting at 2.7, which has been ticking higher. And so they are looking at, the committee is seeking to achieve maximum employment, inflation at the rate of 2% over the longer run. And for those goals, they're keeping the rates steady at 4.25% and 4.5%. And the committee assessment will take into account a wide range of information, including readings on the labor market conditions, inflation pressures, inflation expectations, financial and international developments. And let's see, effective July 31st, 2025, the Federal Reserve Open Market Committee directs the desk to undertake, again, maintain the federal funds rate, 4.25%, 4.5%, conduct standing overnight repurchase agreements or repo agreements with a minimum bid rate of 4.5% with the aggregate operational limit of 500 billion, and roll over at auction the amount of principal payments from the Federal Reserve securities maturing each calendar month that exceeds $5 billion per month. And of course, for MBS, they've exceeded the caps at $35 billion per month. So they've obviously been rolling over their balance sheets as well. So Federal Reserve, let's see, Treasury. So if you go over here, recent balance sheet trend, you can see that it's been declining ever since this was, I forgot what this was. I vividly remember, but then I don't remember the exact reason why we got that spike. It was that liquidity shock for another few banks, I believe, that we went through. This was obviously the huge run up. As you can see, during COVID 2020, 2021, we got that balance sheet swelled up. Why? Because the Federal Reserve was aggressively buying bonds, and they were trying to hold rates down because they were the ones behind all that demand, right? So they were creating all this demand because they were buying bonds straight from treasuries, and they were creating that demand, resulting in prices going up, yields coming down and staying low, so that they can actually offer more liquidity to the market, to the economy, because we were struggling. But then in 2022, we kind of peaked, and since then, you can see that it's been moderating. And this over here, we can see the slope is actually more declining as opposed to the more recent trend, is because of the lower caps. Earlier, they had the Federal Reserve Treasury securities maturing, exceeding 25 billion, but now they've put the cap at 5 billion. So they are lowering that amount a little bit to reduce. This is a bit of a passive way for the Federal Reserve to start that quantitative easing process, and even 35 billion for mortgage-backed securities that remains intact for the Fed. So that is still pretty intact, but you are starting to see the balance sheet runoff a little bit now slower compared to what we're seeing, but it's still coming down. They're still shrinking their balance sheet as they are letting their assets roll over from their balance sheet, right? So let them expire, collect the principals, and not really rebuy back any of the bonds. But yeah, interest rate decision is out. We expected a pause, and that's exactly what we got. The S&P fluctuating quite a bit. It pushed higher than a couple candles of pretty dramatic sell-off, and we're still green on the day. That's the bottom line. And so we'll see what Jay Powell has to say at 2:30 p.m. Eastern. So I'll go over some of the comments here, and make sure that you participate on the poll as well, everyone. We've got a poll going on right before Jay Powell's speech, 320 votes. So make sure that you participate on that poll. ET the extraterrestrial says, greetings from Malta, Karthik. I've been looking into Malta actually. How is it for a place to live and work? I'm very curious. Please let me know, because I've been exploring a lot of countries, especially European countries, because of the time zone. And I really want to look at something which offers that time zone where I can actually come live every day. Like, I would love to be live every single day for all of you, market open, market close. But because of the time zone, it becomes very difficult to stay up till 2 or 3 in the morning. So I was looking into Malta. I was looking into Portugal, of course, a few other countries that piqued my interest. So I'm definitely very interested in learning more about life in all these amazing European countries. So, if you have more insights to share, definitely do reach out, because I'm very curious and I'm always exploring and learning more about these places. So yeah, would definitely love to connect. Tesla here dropping quite a bit here. So we did get a little bit of a bearish pennant, so to speak. So you can see that we're seeing a little bit of this bearish flag or bearish pennant, and Tesla starting to break down a little bit. So you can see this big sell-off, consolidation sideways, and then of course a bigger sell-off for Tesla. So L says, why not the USA? I love the USA. I mean, I go there at least once a year, but there isn't like a very defined immigration program. Like there's H-1B, which is through the job, which is through workforce. But other than that, there's obviously the EB routes where you invest in the country, but that's also pretty expensive. Like you're looking at over $1 million, and there isn't like a pathway defined where, you know, there's no such thing as like a nomad visa or like an entrepreneur visa, things like that, where you can set up a business and move there. So the pathways, the immigration pathways have been a little bit more challenging to kind of maneuver in the US versus I've seen a lot of European countries that have these digital nomad visas or even other kind of visas that allow you to live there, experience a life temporarily, which is really what piqued my interest in the beginning. Is like, you know, that's pretty cool that I can experience life there. So, but yeah, overall, I mean, I love the US. I have a lot of friends and family in the US, and I go there every once a year. We do our annual meetup. We still need to plan our annual meetup for this year. But last year we did it in Tampa. It was amazing. So yeah, it's always fun. It's always great. So Marcelo says, yeah, Portugal and Ireland would be great. I lived there, but I'm in Florida. Nice. Florida is amazing. It's my first time there back in November, and it is one of the best places in my opinion. Like Tampa was great. I haven't been to Miami yet, but Jacksonville and Tampa were just incredible. I loved it. It was the best. So evening now in Europe, people not sleep watching you. So yeah, Europe, I feel like European time zone is actually pretty good because you get to trade a lot of different kinds of markets. You know, when especially when you kind of get in that European time zone where London markets are open, Asian markets are open, the US market will be open at 3-4 p.m., goes all the way till the evening. It's like the ideal time zone for you to be in. The more east you go, the worse it becomes, especially time zones in Australia, New Zealand, Indonesia becomes more tough when you're trading US markets. So yeah, time zone is like one of those things where you got to navigate every time. So NVIDIA have new CPUs. That's why it's up time to load up even more. NVIDIA getting up to $180 here. And NVIDIA has US approval to ship the H20 AI chips to China, confirmed by the National Economic Advisor Kevin Hassett, supporting America's edge in advanced chip tech as well. And we are seeing NVIDIA trading at brand new all-time highs. I mean, this is quite literally the highest price NVIDIA's ever traded at. $179.66, market cap approaching $4.4 trillion here for NVIDIA. Incredible. Absolutely incredible. So let's take a look at my portfolio here. This is what it looks like. Again, I'm really considering rolling out my NVIDIA calls here because I need to have more upside. So I'm looking at 175 for at least one of them. And I know I've been saying that for quite some time, that I'll let them expire. But I feel like I'm now starting to get a little too greedy on NVIDIA here. So I haven't decided yet, but we'll see what I end up doing. Whether it is to roll or whether it is to keep, I haven't decided yet. One of them I'll most certainly roll if NVIDIA stays above 170. This one, of course, is more immediate because it's going to be this Friday. So I'll decide, and of course, I'll update everybody in the Discord as well. So, okay, let's see. The occasional detailer says Tampa's all right. I mean, in Florida, I haven't been to Miami, right? So I was in Tampa and looked pretty cool. Jacksonville was amazing as well. So next time, maybe I'll check out Miami for sure. You can always be in the Caribbean. Yep, I know a lot of countries in the Caribbean that have that flexibility as well, that have very good options. Love traveling and living in Europe, Elle says. Professor Sam, come to Switzerland. I've been to Switzerland once. I've been to Zurich and Bern and Zermatt. And man, incredible. I fell in love. Switzerland is amazing. The natural beauty is breathtaking. And I think I went to Lucerne as well. Lucerne, I remember that. It's incredible. It's very beautiful. So Ireland is beautiful, but not as great as a place to retire due to the punitive taxes on ETS and capital gains, though. Yeah, I mean, taxes is another thing, right? So we've always got to make our decisions around taxes. That can always be a big conversation, big topic of discussion, especially if you are a trader, investor. If you are planning on being more global, then of course taxes are a big topic of discussion here. So anyway, all right, fam, off to play CS2 and join the moon ride. Hold strong, the good stonks. Powell and Shake Trump will send us to the moon. CS2, is it like Counter-Strike? Is that what that is? If it is, then I love Counter-Strike. I don't blame you. I would choose Counter-Strike over Powell any day of the week. It is one of the best games. Like, we used to go, all of our friends, to like a cyber cafe and like play it. And man, those were the days. So Lululemon is... I think it's still a good company. It's still struggling from the overall trend. So, you know, regardless of how great that company is fundamentally, if the trend is not your friend, then, you know, it can really struggle in the short to medium term. And you can see that Lululemon, of course, has been hitting new 52-week lows. It's been trading in a range for, you know, quite some time. And I would mark out a support right about here, at around $207, $208 on Lululemon. So that would be the next support level to watch, with a resistance that stays put at 235, 236 for Lululemon right now. So just have to watch out for the gray hairs while driving down here in Florida. I have heard about the Florida man though. Our good friend and member Dave told me all about it. That every year there's a thing called Florida Man where they do something crazy and they end up in the papers. But I really liked it. Yeah, Rockstar Games looks good, but that would fall under Take-Two Interactive, so that will be TTWO. I know GTA 6 is right around the corner. They're planning on releasing it soon, so Take-Two Interactive has actually seen a massive surge in their stock price. It's up 151% since November 2022, and I would mark out a support right here for Take-Two at 213, 214, all the way up to as 190. And I think it'll be the best-selling game. How many people here are excited about GTA 6? I might actually not make any videos for a month while I'm playing GTA 6 because it's been such a long time. I don't even remember the last time I played GTA, but I think GTA 5 came out in 2013 or 2014. It's been well over 10 years, I think. And man, incredible days. Some of the best days. And you know, the crazy part is that you've got to pace yourself so you don't finish the game too fast. Otherwise, all that fun is gone. So I remember I used to make a rule like, okay, I'm only going to do, only going to play like a couple hours a day, to make sure that I pace myself and not finish it too early, because you got to really enjoy it once you waited for such a long time. I think it's going to be one of the best selling games, and I think Take-Two Interactive could be the huge beneficiary obviously from that. And we'll see what the initial responses are going to be, and it's a lot on the line for Rockstar Games and of course for Take-Two Interactive. So Palo Alto Networks is actually part of our shopping list. So just so everybody knows, this shopping list is going to get updated at the end of this earnings season. So I'll be updating all these stocks plus adding new companies into this shopping list or watch list. Last time you'll notice it was updated towards the end of the first quarter. And so April, May, June, this earnings season is over, and then I'll be updating this in August. So once this gets updated, you'll find brand new stocks as well as existing ideas with brand new price targets, buy targets, support levels, fair values, everything. And Palo Alto Network was actually part of the list, as you can see right here. PANW. SoFi has been part of that list. Robinhood has been part of that list for a long time. Cadence Design Systems has been part of that list. Broadcom has been part of that list. Intuitive Surgical, Oracle. So even if you do backtest this list from how these stocks have done, Technoglass, again, not a lot of people know about these companies. It's a commercial glass provider, very strong fundamentals. Booking Holdings, Interactive Brokers, Amgen, Technoglass, Zscaler. So this entire list will get updated, but a lot of them have been incredible performers, in the last months and weeks and years, right? So I will update this list towards the end of this earnings season. Let me see. Light buy 220. Yeah, I mean right now it's at 211. Fair value is at 176. That's a good support at 220. Heavy buy is at 190 for Apple. So if you come over to Apple stock here on a daily time frame, so yeah, 220 is a little bit higher. And then of course we got the 190 heavy buy, which is going to be right about here. That's the support level. Very strong support for Apple. So Ezadine, why don't you talk about Enphase anymore? We do from time to time talk about it. Obviously I had covered calls on Enphase, which got in the money and then got delivered. My shares got delivered and I got out of Enphase because of the covered calls that end up in the money. But yes, it's been on a very, very, very severe downtrend. So this is the overall lower highs and lower lows on Enphase. And of course, there's been executional problems. Revenue and earnings have obviously come down dramatically for the company. And, we even pinpointed exactly why this started, where if you take a look at the actual income statement and you go, off of quarterly numbers, you'll notice that it obviously peaked on revenue and then it started to really decline in terms of total revenue, gross profit, operating income, as well as net income because of the higher operating expenses. And as a result, the company actually became a loss-making company in the first quarter, second quarter, 2024. And since then, of course, they've had troubles recovering. So, it's and then of course you've got the EV tax credits and the subsidies taken away under Donald Trump, and that's hurting electric vehicles and green renewable energy companies even more, which is obviously causing a bigger issue for Enphase and even Tesla. Tesla seems to be a little bit unhinged about all this. It has its own issues to deal with Elon, but this is the symmetrical triangle that we have. And one thing I will point out is the last time we actually saw a symmetrical triangle just like this on Tesla was back right before the inclusion in the S&P 500. So this was the lower high as well as the higher low on Tesla before this huge run up of over 100%. So very similar, you can see symmetrical triangle formation, and almost exactly is what we're seeing over here for Tesla as well. Not saying that we're going to get a breakout, but it is what it is. It's a symmetrical triangle that looks very similar to what we've seen before. So Kevin says Trump press conference at 4. He's going to track Powell. Yes. And if he doesn't give any hints to cutting rates, we know that Trump is definitely going to bash Powell. Zero Loof says live stream GTA 6. Oh man. Imagine me playing GTA 6, live streaming it while looking at Take-Two Interactive stock and trading it. That would be like next level crazy. Have you ever been to Germany? I have not. I definitely want to go. The only European countries I've been to is Switzerland, Italy, and then the UK, well, London, England, and then Georgia, if you consider that in Europe, or if it's more Eastern Europe. Yeah, Professor Sam says GTA 6 is easily going to be the highest grossing game of all time. No doubt. I'm fully in agreement with you. I think it's going to be absolutely crazy once it drops. So almost 700 people watching. Make sure that you drop a like, folks. Subscribe to the channel if you haven't already. 600 votes right now. It's a pretty split vote. 54% expecting markets to rally after Powell. 46% expecting a dump. And yeah, that's how the markets have been. Pretty split on these things. But Donald Trump, I'm sure, is going to bash Jerome Powell later today. So Johanna, do you suggest to continue to buy SoFi now or wait to see if it gets lower? One of the things that I always base my analysis off of, especially if it's a long-term investment, is the risk of buying greater than the risk of waiting? Or is the risk of waiting greater than the risk of buying? And that's something that we talked about on April 7th. If you remember correctly, that was one of the fundamental bases of our analysis. Is the risk of buying greater than the risk of waiting? And the answer was no, it's not. Because if we are buying on April 7th lows when the risk reward is already really good, then sure, we may see the markets go down further. We may see more blood in the markets. We may see more red, right? And that could be temporary in nature. That could be an unrealized loss. But if you don't, and the markets recover like the way they just did, they've rallied all the way to new all-time highs, that's a lost opportunity, right? So the risk of waiting is far greater than the risk of buying, especially when the risk reward is so good to pass up. And when we ask ourselves questions, whether this stock is worth buying or not, we have to first put down a timeline. Is it a long-term investment? Is it a trade? And if it's a long-term investment, anything that's over 3 to 5 years out, then the next step is really understanding the fair value, the fundamentals for that stock. And then if it's, there has to be some kind of tolerance level or flexibility range within that fair value, because if you're too precise, then there's a chance the stock never comes down to that level and we miss out on that opportunity. So if your fair value is at 19, SoFi is at 20, that's okay. If SoFi is at 18, that's great. If SoFi is at 22, I would argue even on the long term, that is still okay. But for me, SoFi at 21.80, 22 depends very much on whether this is a new position, whether this is a long-term investment, whether it's a trade. From a tradable perspective, I would say no. I mean, it's very overbought and extremely, extended since it's rallied quite a bit, and the trade opportunity is kind of gone unless, of course, we see a bit of a pullback. But from a long-term investment, if you're starting to kind of build out a position, like for me, I've got 1,700 shares. I want to round it up to 2,000. I don't mind picking up another 300 here at these levels. In fact, next month, I might pick up another couple hundred shares of SoFi at $21, $20. I might sell puts at these prices to accumulate more. So, long term, if you're looking at 3 years, 5 years out, I wouldn't worry too much about small cents or dollars, because the gains are going to be worthwhile if the story pans out, if of course the thesis pans out. So all of that is very important to consider. So, okay. AMD, yes, Advanced Micro Devices has been on absolute fire. Quite literally. Sitting at just under 180 now. And all-time high sits at 182. Or no, it sits well over 227. The 52-week high sits at 182. Market cap approaching 300 billion. Which company do you think is going to be the next $1 trillion stock? That is not already at least 500 billion. So let's do it that way, because we'll have a much better idea. Let's see, S&P 500 stocks. I remember there's a list. There we go. Slick charts by weight. Okay. But these companies don't have the market cap, right? I mean, Palantir, I guess these are all going to be companies that are close to the similar market cap because of the percentage weighting. So that's that. But let's see. So I also do believe Palantir is most likely going to be the next $1 trillion stock. Of course, companies that are very close to it are going to be, let's see. So Visa is 681 billion. MasterCard is about 500 billion, over half a trillion. And then we take a look at companies like Broadcom already hit $1 trillion. Tesla's over $1 trillion. JP Morgan is getting very close, I believe. Yeah, 832 billion. Hood. Robinhood. Man, that would be like a 10x. That would be a 10x for Robinhood. From here on out to a 1 trillion would be like 1,000% gain. Oracle, I think Oracle is getting pretty close. It's at 700 billion. So JP Morgan, 900 billion, Visa, Oracle, 700 billion. And then of course you've got, let's see, Walmart. Walmart's at almost 800 billion. It's crazy, right? I mean, up until 2018, I think, you have to go back to 2018, we did not even have $1 trillion stock, $1 trillion company. Apple broke out to $1 trillion valuation. And since then, we are now looking at a company that's approaching 5 trillion, Nvidia, and multiple $2-3 trillion companies. So it's crazy how quickly these companies are gaining value substantially. So yeah, among all these, I think Palantir clearly stands out as one of the most highest growth stocks, as one of the ones that could get up to $1 trillion market cap. You know, it's almost at 400 now. We're looking at just over 150% gain from these levels in order to get up to 1 trillion. JP Morgan, Visa, all these companies are obviously also possible, but they're not growing as fast as Palantir. But they've got a lot less to do in order to get there. Okay, I'm going to end the poll here. Just want to mention that we've got a poll going on. If you want to participate, make sure that you vote in the next couple minutes before we get started on this Jay Powell speech. I will do a quick audio check, so make sure that everything is working well. Just give me a thumbs up if the audio is working well here. And I hope it's not going to be a super long live stream, because I'm not planning on staying up here for such a long time. You think LWLG could really catch? So again, thanks for the donation there. Appreciate that. Lightwave Logic. So looking at some basic technical analysis here, we're looking at pretty overextended levels here. LWLG. Yeah, pretty extended levels here. You can see the RSI, the MACD, L3 banker, oscillator, everything is extremely overbought here. And I would mark out a support very strong right about there at just under $1.80 for Lightwave. So that would be a support level to watch. Okay, so I'm going to end the poll now. We are ready for Powell's speech. 55% of you guys are expecting the markets to rally after Jay Powell. And we are ready. Just, again, give me a thumbs up if the audio is good. And hopefully there are no issues with the audio here.
Good afternoon. My colleagues and I remain squarely focused on achieving our dual mandate goals of maximum employment and stable prices for the benefit of the American people. Despite elevated uncertainty, the economy is in a solid position. The unemployment rate remains low, and the labor market is at or near maximum employment. Inflation has been running somewhat above our 2% longer run objective. In support of our goals, today the Federal Open Market Committee decided to leave our policy interest rate unchanged. We believe that the current stance of monetary policy leaves us well positioned to respond in a timely way to potential economic developments. I will have more to say about monetary policy after briefly reviewing economic developments. Recent indicators suggest that growth of economic activity has moderated. GDP rose at a 1.2% pace in the first half of this year, down from 2.5% last year. Although the increase in the second quarter was stronger at 3%, focusing on the first half of the year helps smooth through the volatility in the quarterly figures related to the unusual swings in net exports. The moderation in growth largely reflects a slowdown in consumer spending. In contrast, business investment in equipment and intangibles picked up from last year's pace. Activity in the housing sector remains weak. In the labor market, conditions have remained solid. Payroll job gains averaged 150,000 per month over the past 3 months. The unemployment rate at 4.1% remains low and has stayed in a narrow range over the past year. Wage growth has continued to moderate while still outpacing inflation. Overall, a wide set of indicators suggests that conditions in the labor market are broadly in balance and consistent with maximum employment. Inflation has eased significantly from its highs in mid-2022, but remains somewhat elevated relative to our 2% longer run goal. Estimates based on the Consumer Price Index and other data indicate that total PCE prices rose 2.5% over the 12 months ending in June, and that, excluding the volatile food and energy categories, core PCE prices rose 2.7%. These readings are little changed from the beginning of the year, although the underlying composition of price changes has shifted. Services inflation has continued to ease, while increased tariffs are pushing up prices in some categories of goods. Near-term measures of inflation expectations have moved up on balance over the course of this year on news about tariffs, as reflected in both market-based and survey-based measures. Beyond the next year or so, however, most measures of longer-term expectations remain consistent with our 2% inflation goal. Our monetary policy actions are guided by our dual mandate to promote maximum employment and stable prices for the American people. At today's meeting, the committee decided to maintain the target range for the federal funds rate at 4.25% to 4.5%, and to continue reducing the size of our balance sheet. We will continue to determine the appropriate stance of monetary policy based on the incoming data, the evolving outlook, and the balance of risks. Changes to government policies continue to evolve, and their effects on the economy remain uncertain. Higher tariffs have begun to show through more clearly to prices of some goods, but their overall effects on economic activity and inflation remain to be seen. A reasonable base case is that the effects on inflation could be short-lived, reflecting a one-time shift in the price level. But it is also possible that the inflationary effects could instead be more persistent, and that is a risk to be assessed and managed. Our obligation is to keep longer-term inflation expectations well anchored and to prevent a one-time increase in the price level from becoming an ongoing inflation problem. For the time being, we're well positioned to learn more about the likely course of the economy and the evolving balance of risks before adjusting our policy stance. We see our current policy stance as appropriate to guard against inflation risks. We're also attentive to risks on the employment side of our mandate. In coming months, we will receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate. At this meeting, the committee continued its discussions as part of our 5-year review of our monetary policy framework. We focused on potential revisions to our statement on longer-run goals and monetary policy strategy, and are on track to wrap up any modifications by late summer. The Fed has been assigned 2 goals for monetary policy: maximum employment and stable prices. We remain committed to supporting maximum employment, bringing inflation sustainably to our 2% goal, and keeping longer-term inflation expectations well anchored. Our success in delivering on these goals matters to all Americans. We understand that our actions affect communities, families, and businesses across the country. Everything we do is in service to our public mission. We at the Fed will do everything we can to achieve our maximum employment and price stability goals. Thank you. I look forward to your questions.
Thanks, Chair Powell. There's a lot of lean in the markets, and not to mention out of the administration for a rate cut now in September. Is that expectation unrealistic at this point?
So, as you know, today we decided to leave our policy rate where it's been, where I would characterize as modestly restrictive. Inflation is running a bit above 2%, as I mentioned, even excluding tariff effects. The labor market's solid, historically low unemployment, financial conditions are accommodative, and the economy is not performing as though restrictive policy were holding it back inappropriately. So it seems to me and to almost the whole committee that the economy is not performing as though restrictive policy is holding it back inappropriately, and modestly restrictive policy seems appropriate. All that said, there's also downside risk to the labor market. In coming months, we'll receive a good amount of data that will help inform our assessment of the balance of risks and the appropriate setting of the federal funds rate.
So just to follow up, by coming months, does that include the possibility you'll be getting essentially 2 rounds of jobs and inflation data between now and the September meeting? Is that potentially adequate to make a decision to lower rates at that point?
So you're right, we do have, this is an intermeeting period when we'll get 2 full rounds of employment and inflation data before the time of the September meeting. We have made no decisions about September. We don't do that in advance. We'll be taking that information into consideration and all the other information we get as we make our decision at the September meeting.
Steve.
Thank you, Mr. Chairman. You took out the word, or the notion that uncertainty has diminished from this statement. Does that mean uncertainty has increased? And I'm just wondering, the administration has struck several deals with large trading partners where it seems like we now know what the rate is going to be. Does knowing that rate add to your certainty to change policy, or do you need to wait to see the economic effects?
So essentially, the statement in our statement about uncertainty reflects what's gone on since the last meeting. So at the time of the last meeting, uncertainty had moved down a little bit, but it was more or less even this time. So we took out, had diminished because it didn't diminish further. So there's not really much in that. And then your second question is, say again?
There have been several deals that have been struck, and now we seem to have an idea of what the tariff rates are going to be with some of our large trading partners. Does that not add to the kind of certainty you might need, or is it you're waiting for the economic effects to show themselves?
No, I think we're still, you're right, it's been a very dynamic time for these trade negotiations, and lots and lots of events in the intermeeting period, but we're still a ways away from seeing where things settle down. We are clearly getting more and more information, and I think at this point, people's estimates, our estimates, outside estimates of the likely, effective level of tariffs is not moving around that much at this point. But at the same time, there are many uncertainties left to resolve. So yes, we are learning more and more. It doesn't feel like we're very close to the end of that process, and that's not for us to judge, but it feels like there's much more to come, as well, looking ahead.
Neil.
Hi, Mr. Chairman. Neil Irwin with Axios. This morning we got a GDP report in which final domestic private purchases decelerated, slowest pace since 22. There was a weakness in the interest-sensitive sectors and residential investment, commercial structures. Are those not signs that monetary policy is a little too restrictive right now, given current economic conditions?
So the GDP and PDFP numbers came in pretty much right where we expected them to come in. You got to look at the whole picture. So certainly, as I mentioned in my opening remarks, economic activity data, GDP, private domestic final purchases, which we think is a narrower but better signal for future, for where the economy is going, has come down to a little better than 1%, 1.2%, I think, in the case of GDP for the first half, whereas it was 2.5% last year. So that has certainly come down. But if you look at the labor market, what you see is, by many statistics, the labor market is kind of still in balance. It's things like quits, job openings, and let alone the unemployment rate. They're all by many measures, very similar to where they were a year ago. So you do not see weakening in the labor market. You do see a slowing in job creation, but also a slowing in the supply of workers. So you've got a labor market that's in balance, albeit partially because both demand and supply for workers is coming down at the same pace, and that's why the unemployment rate has remained roughly stable, which is why I said we do see downside risk in the labor market. I mean, our two mandate variables, right, are inflation and maximum employment, stable prices and maximum employment, not so much growth. So the labor market looks solid. Inflation is above target, and even if you look through the tariff effects, we think it's still a bit above target, and that's why our stance is where it is. But as I mentioned, downside risks to the labor market are certainly apparent.
So on labor, given the fluid labor supply situation, is there a number for this jobs report we get on Friday that would look to you like equilibrium job growth?
The main number you have to look at now is the unemployment rate, because it's true that the demand for workers in the form of, let's call it, just say payroll jobs, that number has come down, but so has the break-even number, kind of in tandem. So, as long as that puts the labor market in balance, the fact that it's getting into balance due to declines in both supply and demand, though, I think it is suggestive of downside risk. So, we of course, will be watching that carefully.
Thank you. Colby Smith with the New York Times. Two of your colleagues called for a quarter-point cut today, and I'm wondering what aspects of their argument were most compelling to you and how you're weighing their views against those on the committee who, as of the June forecast, were in the camp of the Fed holding interest rates steady for the remainder of the year. And just in terms of the June SEP in particular, is that still the best representation of where the core of the committee is?
So on the dissents, what you want from everybody and also from a dissenter is a clear explanation of what your thinking is and what are the arguments you're making, and we had that today. So I think basically this was quite a good meeting all around the table where people were thought carefully about this and put their positions out there. As I mentioned, the sort of the majority of the committee was of the view that inflation's a bit above target, maximum employment is at target. That calls for modestly restrictive, in my way of thinking, modestly restrictive stance of policy for now. But we had two dissenters who I think, you want that clear thinking and expression of your thinking, and we certainly had that today, I think all around the table. In terms of, you asked about the June SEP, I wouldn't, you're right, that's what it says, and that may well, I couldn't point to it 6 weeks later as expressing people's thought. You really can't do that. We don't run an SEP, and I don't like to substitute in my own estimate of what the SEP might be. We don't have one. So I'll just say that, we haven't made any decisions about September. We'll be monitoring all the incoming data and asking ourselves whether the federal funds rate is in the right place.
And just on the point about policy being only modestly restrictive, does that mean that there's actually not much scope to reduce rates once the conditions for a cut are met, barring a significant weakening of the labor market?
So let me say, my own estimate is modestly restrictive, and there are a range of views of what the neutral rate is at this moment for our economy, and so others may say it's more restrictive or less restrictive even. We're going to be at some point when we return to moving toward a more neutral stance, we'll be making that judgment as we go. I don't think we have a preset course. It's not so mechanical as saying, we've derived with great confidence the neutral rate and that is our destination, because really we understand that no one actually knows what the neutral rate is. We know it by its works, and that will be the way the economy reacts over time to slightly looser policy.
Nick Timmeros, The Wall Street Journal. Chair Powell, my question is about what have you learned over the last few months about the inflation generating and price pass-through process? And just to drill down, the June CPI report showed evidence of tariff-induced goods inflation. Now, the tariff landscape is only starting to be settled with some of these more recent deals. Given the lags between when tariffs are announced and when they show up in goods prices, is 2 months a long enough horizon to evaluate the impact and be confident that tariffs aren't impacting the broader inflation process?
I think you have to think of this as still quite early days. And so I think what we're seeing now is substantial amounts of tariff revenue being collected on the order of $30 billion a month, which is substantially higher than before. And the evidence seems to be mostly not paid only to a small extent through exporters lowering their price. and companies or retailers, sort of people who are upstream, institutions that are upstream from the consumer, are paying most of this for now. Consumers it's starting to show up in consumer prices, as you know, in the June report. We expect to see more of that. And we know from surveys that companies feel that they have every intention of putting this through to the consumer, but the truth is they may not be able to in many cases. So I think we're just going to have to watch and learn empirically how much of this and over what period of time. I think we've learned that the process will probably be slower than expected at the beginning, but we never expected it to be fast. We think we have a long way to go to really understand exactly how it will be. So that's how we're thinking of it right now.
So if I could follow up, is the reticence to look through core goods inflation being driven by the judgment that during the pandemic expectations proved more adaptive than anyone at the Fed expected? Is it being driven by uncertainty over how restrictive policy is?
You could argue we are a bit looking through goods inflation by not raising rates. We haven't reacted to new inflation, but I mean, I wouldn't insist upon that. But I think the base case, as I said, a reasonable base case is that these are one-time price effects. Of course, in the end, there will not be. This will not turn out to be inflation, because we'll make sure that it's not. We will, through our tools, make sure that this does not move from being a one-time price increase to serious inflation. We want to do that efficiently, and that means we want to do it. If you move too soon, you wind up maybe not getting inflation all the way fixed, and you have to come back. That's inefficient. If you move too late, you might do too unnecessary damage to the labor market. So there won't be, in the end, a big inflationary problem. What we're trying to do is accomplish that in a way that is efficient. But in the end, there should be no doubt that we will do what we need to do to keep inflation under control. Ideally, we do it efficiently.
Michael McKee from Bloomberg Television and Radio. The one big bill, leaving aside the adjectives, do you expect it to add stimulus to the economy in 2026? And would that be an argument for remaining on hold or cutting back on the number of rate cuts you would expect for next year?
So, of course, let me just ritual disclaimer that we don't express any judgments or anything like that on fiscal legislation or other legislation for that matter. But I would say, when you think that, the biggest part of the bill was making permanent existing law on taxes, I don't think we see it as particularly stimulative. There should be some stimulative effect, but it shouldn't be significant over the next couple of years.
And to follow up, I don't want to put this in terms of you and the president, so let me ask it this way. Do you have concerns about the cost to the government of keeping rates elevated for longer in terms of interest rate charges?
No, that's, we have a mandate, and that's maximum employment and price stability. And it is, it's not something we do to consider the cost to the government of our rate changes. We have to be able to look at the goal variables Congress has given us, use the tools they've given us to achieve those goals, and that's what we do. We don't consider the fiscal needs of the federal government. No advanced economy central bank does that, and it wouldn't be good if we did do that, it would be good neither for our credibility nor for the credibility of U.S. fiscal policy. So it's just not something we take into consideration.
Victoria.
Hi, Victoria Guida with Politico. When it comes to the renovations of the Federal Reserve's headquarters that the administration has been looking into, do you see their interest in that issue as being directly tied to the president's push to get you to lower interest rates?
Not for me to say. I will say we had a nice visit with the president. It was an honor to host him. It's not something that happens very often at the Federal Reserve to have the president come over, let alone to visit a building. But it was a good visit.
Are there any aspects of the project that they've raised that you see as making you reconsider any aspects of the project?
So, this project was hatched and conceived almost a decade ago now, and we went through the very long process of clearing it through historic preservation at the National Capital Planning Commission, and a lot of back and forth there. Was very constructive. We started out to do the work, and we're very well along on that work, and I was quite pleased to have the president say multiple times that what he really wanted to see was us getting this construction completed as soon as possible. That is our focus, and that's what we're going to do.
Thanks, Mr. Chairman. Andrew Ackerman with the Washington Post. What message do you take from the fact that inflation hit 2.1% last September and has bounced higher since? Why do you think financial conditions are restrictive and a neutral rate's below 4% when inflation has stopped falling for almost a year?
So inflation, when you talk about these 12-month inflation measures, you're always battling residual seasonality. So we'll have, for example, 2 months of high inflation sometimes early in the year, and then inflation turns lower, and a lot of that may just be an artifact. So that's why we look at the 12-month numbers. I think inflation is most of the way back to 2%. There are things like the catch-up inflation. So, for example, all the insurance costs that are they're only now going through inflation, but they actually reflect inflationary pressures from 2-3 years ago. So that's got to go through. In addition, now we have 3 or 4 tenths of inflation in core inflation from tariffs. So, and we can't really separate that out. We're not going to have a separate kind of inflation that isn't the tariffs. We're always going to be dealing with all of inflation. But the composition, as I mentioned, has really changed. And if you go back to the last couple of years, it was all about services inflation, which was being very sticky. Now services inflation is coming down nicely. Goods inflation was well behaved before, and now goods inflation is going up. So the story has really changed. That's partially because of tariffs. It's also partially because we had restrictive policy in place, and we've seen that the result of that gradually work its way through the services economy.
Okay, the other thing I wanted to ask is, are you comfortable that BLS can continue performing their mission effectively if they take an 8% reduction in headcount and authorize spending as the administration has proposed?
I'm not going to comment on the administration's proposal. I do think, as I've said, I think that we're getting the data that we need to do our jobs, and I think it's really important that good data helps not just the Fed, it helps the government, but it also helps the private sector. People in the economy, they use this data a lot too, so it's quite important for our economy and certainly for the Fed's work and other government agencies' work that we continue to get better at data. That's what we've been doing for 100 years. We've been getting better and better and better. It's very hard to accurately capture in real time the output of a $20+ trillion economy. And the United States has been a leader in that for 100 years, and we really need to continue that, in my view.
Edward.
Thank you, Mr. Chairman. Edward Lawrence from Fox Business. How concerned are you with the data that we're coming in, showing no significant upward trend in inflation over the past 6 months, that the wait-and-see approach for inflation is actually giving companies cover to raise prices?
How concerned am I that say that again?
The wait-and-see approach is giving...
The wait-and-see approach, what do you mean by that?
For cutting rates. You're waiting to see if the tariffs will affect inflation. So it's a wait-and-see approach.
Well, so that's where policy's restrictive. When we start cutting, it'll go toward neutral.
Okay. This delay, though, where you're saying there's a one-time price increase for tariffs, which possibly could lead into bigger inflation or more inflation. Is that giving companies cover, though, to raise prices?
Well, what may be giving, it's not our policy stance, what may be giving some companies will certainly be taking advantage of the fact of the tariffs and all of the discussion of how they're going to, the companies will raise prices when and as they can. And you saw it famously in the first administration of President Trump during those tariffs. Washing machines were tariffed, but dryers weren't. But what do you know? The price of dryers went up too, just like washing machines. So companies will often just cross the street in a group, if you know what I mean. That'll happen. We don't see a lot of that. I mean, what we see now is basically the very beginnings of whatever the effects turn out to be on goods inflation. And I'll say again, they may be less than people estimate, or more than people estimate. They're not going to be zero. consumers will pay some of this. Businesses will pay some of this. Retailers will pay some of this. But we're just going to have to see it through.
And just to follow, if I could, some additional tariffs have been in place since February, and things really haven't broken yet with the economy. So how do you justify to somebody who's looking for a house, who's facing a 7% mortgage and maybe can't afford those rates? How do you justify that?
Well, so the housing is a special case, right? We don't set mortgage rates at the Fed, right? We set an overnight rate, and the rates that go into mortgages are longer term rates, like treasury rates. It might be 30-year rates, it might be shorter than that, but it's not the overnight Fed's rate. It's not that we don't have any effect. We do have an effect, but we're not the main effect. There are other things going on in the housing sector, and one of those is just there's a kind of a long-term housing shortage that we have. We haven't built enough housing. This is not something the Fed can help with, and that'll be the case even after things normalize. So I think the best thing that we can do for housing is to have 2% inflation and maximum employment, and that's what we can contribute to housing. There are lots of other jobs to do for the private sector and Congress, but that's what we're trying to get to. I mean, we've made a lot of progress toward that. We have a very good labor market right now. Inflation, we were very close to 2%. We're seeing some goods inflation move us away, but so far not very far away.
Chris.
Hi, Chair Powell. Thank you. Well, can you give us a little more about what kind of economic data does the Fed need to see before you'll be ready to cut? I mean, do you need inflation back nearly to target? Are there other things in the pricing that you look for? Do you need to see weakening in the job market? What kind of things are you looking for?
I mean, ultimately, it could be any of those things, right? But if you saw that the risks to the two goals were moving into balance, if they were fully in balance, that would imply that you should move toward a more neutral stance of policy. This is the special situation we're in, which is we have two-sided risk to both of our goals. When we paused, inflation was above target and the labor market was pretty good. So that was a time when policy was restrictive when we paused. And to be restrictive is to be supporting a return to our inflation target, right? So as the two targets get back into balance, you would think you'd move in a way closer to neutral, and that the next steps that we take are likely to be in that direction. What will it take? It'll be the totality of the evidence. As I mentioned, there's quite a lot of data coming in, which before the next meeting, will it be dispositive of that? It's really hard to say. We don't make those decisions right now, so we'll have to see.
Well, I guess just in terms of inflation, though, for example, like some people would point to if it remains only in goods and it doesn't bleed over to services, then maybe that's evidence that the tariff effect is going to be a temporary one-time thing. Is that kind of thing affect your thinking, or do you just need to see the number come down? I think closer to 2.
We'll look at everything. It's as I mentioned, a pretty reasonable base case is that this will be a one-time price increase, and in the end, we'll make sure that that's the case. We're just trying to do that efficiently. And efficiently means getting the timing right, so we don't. Again, if we cut rates too soon, maybe we didn't finish the job with inflation. History is dotted with examples of that. If you cut too late, then maybe you're doing unnecessary damage to the labor market. So we're trying to get that timing right, and that's effectively what we're doing.
Claire Jones, Financial Times. Just a question on the dollar. We've seen it decline quite heavily this year. I was wondering if there's been any discussion about that at the meetings and to what degree that might be complicating your attempts to get inflation back to target. Thank you.
So this goes back to the division of labor between the Fed and the Treasury, as you I'm sure know, and the Treasury only speaks to the dollar. It's not something that's been a topic of major discussion at all at the Fed. I would say it doesn't come up. If the transcripts, when they come out in a few years, they'll probably reflect some mentions of the dollar, but it would never be a major focus.
And just to follow on, if I may, to Andrew's question, I think the amount of imputed data in CPI now is up to 35%. I mean, is there any discussion of that as well? Is there any consideration of looking at alternative measures, data scraping and so on, in order to just ensure you've got a good read on what's happening to prices in the US economy? Thank you.
Yeah, we're monitoring the situation. We do, of course, I mean, as you know, during the pandemic, we looked at a whole lot of new kinds of data. People are looking at big data sets that you can get from all sorts of places, and we do all of that. But at the same, we really need the government data. Really is the gold standard in data, and we need it to be, to be good and be able to rely on it. And we're not going to be able to substitute for that, but if we have to make do with what we have. But I certainly hope that we get what we need.
Jay O'Brien.
Hi, Mr. Chairman. Jay O'Brien, ABC News. President Trump has obviously invoked your name a lot. He has personally pressured you. Are you concerned the way that conduct might impact the Fed's independence going forward?
I'll just say that, I think that having an independent central bank has been an institutional arrangement that has served the public well. And as long as it serves the public well, it should continue and be respected. If it didn't serve the public well, then it wouldn't be something that we should just automatically defend. But what it gives us and other central banks, what it gives you is the ability to make these very challenging decisions that in ways that are focused on the data and the evolving outlook, the balance of risks and all the things we talk about, and not political factors. And so governments all over the advanced economy world have chosen to put a little bit of distance between direct political control of those decisions and the decision makers. So if you were not to have that, there would be a great temptation, of course, to use interest rates to affect elections, for example. And that's something that we don't want to do. So I think that's pretty widely understood. Certainly it is in Congress. And I think it's very important. I'll just say that.
Maria Eloisa.
Afternoon, Chair Powell. Maria Luisa Capurro from Bloomberg News. You mentioned a slowdown in consumer spending, and I wanted to see if you could walk us through what was the discussion with the committee around that. We've seen delinquency rates rising for upper income households. How do you see that evolving in the next few months? How much of a vulnerability that is for the economy going forward?
Consumer spending had been very, very strong for the last couple of years, and had repeatedly, forecasters, not just us, had been forecasting it would slow down, and now maybe it finally has. So I would say, if you talk to credit card companies, for example, they will tell you that the consumer's in solid shape and that spending is at a healthy level. It's not growing rapidly, but it's at a healthy level, and delinquencies are not a problem. You mentioned high-end delinquencies. I don't know what to make of that. I read the same thing, but so generally, and if you look at the banks, and when the banks talk about in their earnings calls, the performance of credit has been good. So essentially, you have a consumer that's in good shape and is spending, not at a rapid rate, but it's true, and it was again right in line with what we expected. The GDP data that we got this week. And I think it's still a little bit difficult to interpret because you have these massive swings in net exports, which may also be affecting, some of that can affect consumer spending as well. Look, it's one of the data points that we pay most careful attention to, and there's no question that it's slowed, and we're watching it closely, but we also watch the labor market and the performance of inflation. Those are our two variables that we're assigned to maximize.
And just to follow up on what my colleagues were asking about this sense, Governor Waller said that the labor market is on edge, and he was pointing to weaknesses on the private sector. I was wondering, you said that the main number to look at is the unemployment number overall, but what was the discussion about the state of the private jobs market?
So I'm not going to talk about any individual's, any individual's comments. I wouldn't do that. But I think what we know is that private sector job creation, certainly in the last report, we'll see on Friday, but had come down a bit. And if you take the QCEW adjustment seriously, it may be even low, maybe close to zero. But the unemployment rate was still low. So what that's telling you is that demand for workers is slowing, but so is the supply. So that's it's in balance. Oddly enough, you've got a very low unemployment rate, and it's kind of been there for a year as job creation has moved down. But also we know that because of immigration policy, really, the flow into our labor force is just a great deal slower, and those two things have slowed more or less in tandem. If you look at things like I mentioned, quits, look at wages. Wages are gradually cooling. Look at vacancies to unemployment. Those things have been pretty stable they haven't really moved a lot in a full year. So I think if you take the totality of the labor market data, you've got a solid labor market. But I think you have to see that there are downside risks. You don't see weakening in the labor market, but I think you've got downside risks in a world where unemployment's being held down because both demand and supply are declining. I think it's worth paying close attention to it, and we are.
Nancy.
Hi, Chair Powell. Nancy Marshall-Genzer with Marketplace. One more question. The two dissents. Was there talk?
All right, everyone. So I'm going to end it there. It's getting a little late here. I don't want to be up too late. Like I said, I'm focusing on my health for this week. So thank you so much for joining. There's, I think, only a couple more questions left. So markets here obviously dropping a little bit, seeing a bit of a pullback, but we will be back at it with the market update. I will share the link in our Discord to finish up the FOMC. There's only a few more questions, I think 1 or 2 questions left. But yeah, not a lot from Jerome Powell, but of course, monitoring the mandate of both the labor market as well as inflation as well. So thank you so much for joining in. Really appreciate you all. Take care. Have a great day. I'll see you all in the next video. Take care.